Linsay asks, am I in the right super fund investment category? Good question. It depends on your age and your personal circumstances, but big, broad, general rule of thumb, when you're in the accumulation phase, that's sort of between the general ages of 18 to 45, when you're focused on paying down the mortgage and you've got a long time before you can touch your super, you're needing insurance and you don't really want to impact your cash flow too much. That's the kind of stage that accumulator is in. Accumulator referring to that they're trying to accumulate assets. The general a general rule of thumb is that you can be in a higher risk investment. So the high risk investments from a Christian super perspective is the ethical high growth and the ethical growth. The ethical high growth used to be called ethical shares. Now, the reason for that is because you've got a long time before you're going to be able to access the money, and that should give you, the long time frame should give you the potential that those higher risk investments will provide a better long-term outcome than a lower risk investments over that long time frame. That's what historically has happened over a long time frame. As you approach the pre-retirement and the transition to retirement stage of 45 to 65, broadly, these are generalizations, very broad generalizations, then your expenses are generally starting to fall, your mortgage might be paid off, and you're focusing on retirement or semi-retirement. You might be starting to access the funds. When you're starting to move to pension phase and drawing down on it, it's generally a good idea to move to a more conservative portfolio so that you're not getting the volatility in the fund whilst you're drawing from it. And so when you're drawing from it, you're not negatively impacting your overall portfolio. Better to have a more stable portfolio at that stage. So you might drop down a couple of notches, one or two notches, to ethical growth or ethical balance at that phase. And when you're in retirement phase, 65 plus or even earlier, if you're drawing a pension, then you might drop to even a more conservative portfolio, ethical stable or ethical cash. Now, a reason why you might not go to ethical cash is that it has a longer term return of around 4 to 5%. But if you need more income than that's going to provide, you might need to take a little bit more risk and invest in a more risky portfolio to try and get a better long-term return rather than using up all the cash and having nothing to live on in the latter years. So it really depends on your own circumstances, but here's a broad generalizations.